Hello and welcome to 5 Year Club video number 141. We're going to talk a little bit in depth today about mortgage interest rates. What? I was inspired by an article I saw today. Mortgage rates hit 7-year high. Mortgage rates have been low for quite a while, and they've been ticking up for the last, couple years. So I wanted to read this article, and then I wanted to talk about a few of the things in the article so that you would understand the article better. Washington, Treasury yields have been steadily rising and spiked this week, sending mortgage rates to the highest level in years. Freddie Mac says a 30-year fixed-rate mortgage averaged 4.61% this week, matching the highest level since May 19, 2011. A year ago, 30-year rates averaged 4.02%. Mortgage rates loosely follow the rise and fall of 10-year Treasury yields, now hovering just shy of 3.1%, near a 5-year high. Healthy consumer spending and high commodity prices spooked bond markets and led to higher mortgage rates over the past week, said Sam Cotter, Freddie Mac's chief economist. Not only are buyers facing higher borrowing costs, gas prices are currently at 4-year highs just as we enter the important peak home sales season, Cotter said. Even so, Freddie Mac said this year's higher rates have not yet caused much of a ripple in the strong demand levels for buying a home seen in most markets, but inflationary pressures and the prospect of rates approaching 5% could begin to hit the psyche of some prospective buyers. A 15-year fixed-rate mortgage averaged 4.08% this week, up from 4% last week. A 5-year adjustable rate mortgage averaged 3.82%, up from 3.77%. And of course, these adjustable rate mortgages are crap because later they can adjust and you're no longer paying 3.82%. You're paying something significantly higher. And since rates overall are on the way up, your adjustable rate mortgage would be on the way up. All right. So, well, first I got to say, number one, 4 or 5% for a mortgage. I think my 30-year mortgage, when I bought in 2009, was 5.7, 5.825, something like that. I forgot. Anyway, 5.875, maybe that's it. Yeah, it wasn't very good. I was paying a lot. But a lot. I mean, the thing to remember is even a higher rate on a cheaper property is still affordable. You just can't afford as much property. And so the thing that really controls the affordability is the amount that the property costs. Another thing that I'll say is that people like to talk about how mortgage interest rates going up and down impacts home demand to purchase a home. But there are a lot of other factors that affect home purchasing demand, such as demographics, how many people are entering a time in their life when they would consider buying a home, how many homes are available on the market, how well is the economy doing, and let's see, what's the final one? Oh, and just unemployment rate. Is everybody employed? And all of those things impact, at least as far as I believe Shiller, what's the guy's full name? I forgot. Yale economist, famous guy. Anyway, he doesn't think that these mortgage interest rates impact home purchasing demand all that much. He thinks that all these other factors are more controlling of it. All right, so let's get into some of the details here. And I'll link all this stuff in the description. I pulled this just so you can see what the numbers look like right now. 30-year fixed, the rate is 4.51. The APR is 4.58. This is the annual something, I forgot. Anyway, basically, the rate is the actual rate on your loan. The APR is a kind of theoretical rate if you folded the closing cost of the loan into the mortgage. So for example, say you wanted to take out a $150,000 loan. They might charge you $2,000 up front to take out that loan. And so what this APR is it's including the borrowing cost and the fees basically into this rate so that you can compare kind of apples to apples when you're looking at different loan providers. I think these numbers are from Zillow. I don't know who the Ultimate Bank is. So 4.51 for the 30-year, 4.31 for 20-year. 20-year is a little bit weird. 3.94 for a 15-year, and 3.85 for a 10-year. So not all that much of a difference between the 15-year interest rate and the 10-year interest rate. Bummer. By the way, if the 15-year and 10-year had exactly the same interest rate, you could take out a 15-year, and if you wanted to basically pay it off in 10 years, you would just increase your payment by the amount of principal difference between the 10 and the 15, and then you would essentially be on exactly the same payment plan as the 10-year. Anyhow, blah, blah, blah. These are the rates for what it's worth. Those are the adjustable rates. You can ignore them. Adjustable mortgages suck. Let's cover some basics. What the hell's going on? A mortgage is a fixed monthly payment to pay off a big-ass loan, usually for $100,000 or more. If you only need $40,000, it's usually hard to get a mortgage for $40,000. That most people use to purchase real estate. A mortgage is composed of two parts: a principal part, and that part is the part that pays down the loan balance, and an interest part, and that is the part that you just lose, but at least it's tax write-off. So you lose like whatever your payment number says, times 1 minus your tax rate. Anyway, each month the principal amount goes up a little bit, and the interest amount in your mortgage goes down a little bit, but they always add up to the same number throughout the life of the loan. This is good because they don't increase with inflation, which means that inflation helps you over time. And also, of course, if you have a growing career over time, that fixed housing cost is going to be less of a burden over time. I have to say, though, that the principal and interest, the amount that they move every month in your favor is very small. It can be like $5. And I think, it's very, very small. So don't get too excited about that movement. All right, and where do the rates come from? Well, they mentioned in the article that mortgage rates loosely track 10-year Treasury yields, right? So here we can see a graph of that. The black line is going to be the 10-year Treasury yield, and then we have a 30-year fixed rate mortgage as the green line, and then we have a 15-year fixed rate mortgage as the blue line. So we can see, they basically track that 10-year Treasury yield. Well, what is a 10-year Treasury yield? Well, Treasuries are bonds, and they are sold at auction by the U.S. government. It is like the way that the U.S. government borrows money from people. So I'm just going to read this because I think it explains it well. This bond, which is sold at auction by the U.S. government, also tends to signal investor confidence. When confidence is high, the 10-year Treasury bonds price drops and yields go higher because investors feel they can find higher returning investments and do not feel they need to play it safe. But when confidence is low, the price goes up as there is more demand for this safe investment and yields fall. This confidence factor can also be explored in non-U.S. countries. Often the price of U.S. government bonds is impacted by the geopolitical situations of other countries, with the U.S. being deemed a safe haven, pushing the prices of U.S. government bonds up as demand increases and lowering yields. Right, so basically the way people are saying or viewing this is that they believe that mortgage payers in the U.S. are quite reliable, but they are a bit riskier than U.S. 10-year treasuries, and so they're going to charge more interest so that they get compensated for taking on more risk. But fundamentally, they think that U.S. mortgage payers are very reliable. And, in a lot of ways, their alternative is the U.S. Treasury yield, is to buy U.S. Treasuries, because it's a relatively safe asset class. And I guess that's why they follow each other. Yeah. I'm not an economist, though. Maybe there's a completely different reason they follow each other. I'm just guessing at that because the price of these are based on an auction. All right. So that is how, these fixed mortgage interest rates come about. That's interesting. All right. Next thing I'd like to point out about mortgages is the years that it takes until you have paid down 50% of your mortgage. If the value of the property doesn't change over time, then this is going to represent your equity in the property. So what I'd like you to notice is that on a 30-year mortgage, it takes 20 years of paying until you have 50% of that loan paid off. Okay, with a 15-year mortgage, it only takes 8 years until you have 50% of that loan paid off. That's a huge difference. 2 decades versus less than 1 decade. The pay down is happening much faster with this 15-year mortgage. Of course, the payment on the 15-year mortgage is higher, but the interest rate is also lower. So you're losing less money and you are gaining more home equity faster with this 15-year mortgage. 10-year mortgage is 5 years until you get to 50%. Not a huge difference between 10 and 15. I mean, it's 3 years, but it's not like 12 years, which is the difference between 30 and 15. I haven't heard of that many people going for 20-year mortgages. I don't think I have anything against them. They just don't seem to be very popular. And I believe, though, that this pay down progress thing is a big deal. Life is very uncertain, and I think there are a lot of advantages to building up your home equity within 10 years instead of having it only at 50% at the 20-year mark. There's a big advantage to having the loan completely paid off after 15 years compared with 3 whole decades. And so this is the reason why I think it's good to go for these, 15-year or less mortgages. And the final thing I'd like to say a few things about is refinancing. Generally speaking, you're going to refinance to save money to get a lower interest rate. You can also save money by making extra principal payments, by prepaying the mortgage, as they would call it. And that is what I did when I paid down my mortgage for the most part. I made extra principal payments until I had around half of my mortgage left, and then I just kind of saved up this big cash hoard in a savings account until I could just pay off the thing in full, and then I made one payment and paid it off in full. So yeah, making extra principal payments will decrease the total amount of interest that you will pay. And you can think of making these extra principal payments as investments where the return is your mortgage interest rate. So for example, if you get a very, high mortgage interest rate, like 6%, then paying down that mortgage is a guaranteed 6% return on that money for the life of the loan. Because you would have paid that 6% in interest had you not, in the future, had you not paid down your mortgage. If you have a low interest rate on your mortgage, then making these extra principal payments doesn't save you as much money. But if you have a low interest rate, you should also, in theory, be able to pay off the loan faster. So I take a very aggressive approach toward this whole thing. I think people should buy a very modest property that they can pay off within 10 years, definitely within 15 years, and then upgrade their housing later with cash. So I believe in these kind of extra principal payments regardless of the return on them. If your credit is bad or rates are lower later, you may want to consider refinancing. My personal situation, I refinanced from a 30-year to a 10-year because when I first got the condo, I was concerned about just making the payment as low as possible because it was my first home, and I was worried that just something would happen and I would screw it up. And so I got a 30-year because the payment would be really low, and I could rent it out if my life collapsed. I could rent it out, and the rent would make that 30-year mortgage, so it would be safe and I wouldn't get hosed. But later on, I guess about say 5 years later, my credit was better, my income was higher, and and mortgage rates were much lower, and so it made sense for me to change it from a 30-year to a 10-year. I think I saved about, I want to say $250 or $300 a month in interest payments, which was a big win. And it took about 18 months to break even. I knew I wasn't going to pay it off in 18 months, so it made sense to do that. Another thing that's good to know about mortgages is that the principal payment amount for a given fixed duration, so if you're paying off a 30-year mortgage or a 20-year mortgage or a 10-year mortgage, the principal payment amount is going to be the same no matter what interest rate that you get. So the rate that you pay down the loan is going to be exactly the same no matter what interest rate you get. It's just the amount of money that you lose in that interest part of the payment is going to increase as your interest rate increases. And finally, just the simple calculation, if you want to determine if it's worth it for you to refinance, then what you would want to do is use a mortgage calculator and figure out what your new payment would be, what your new interest payment would be, and then you would figure out what your old what your current interest payment is, and you subtract them, and that's the amount that you're going to save every month. And it's going to cost you money to refinance. So you're going to take that refinance cost, and you're going to divide it by the savings per month, which is just the difference in the interest payments. And that is going to tell you how many months it is until you earn back this refinancing cost. And so if you find out that it's going to be like a long time, then the difference in those interest rates is not enough to motivate the refinance. But if you find out that like it's going to make sense after only about a year, then yeah, if you know you got 5 years, 10 years left on this thing, then it's probably worth it to refinance. And finally, I've got a link to some very useful mortgage calculators. I've probably posted this link before. These were very helpful for me as I was navigating my payoff and just testing different scenarios and trying to figure out what was going on with mortgages and how they worked. So that is it. I hope that gives you a little bit more insight into mortgages, about how they work, where the rates come from, and what the deal is with prepayment and interest rates and how those interact. Have a fabulous evening.